We're back, and this is the part of the show where we go to the mailbag. If you got a question, the place to find that is on our website at annexwealth.com. Look for the Ask tab. On the show today, Fred Coleman, Branch Director, Wealth Manager, and a CFP. Hey, Fred.
Hey, Danny.
Matt Morzy, Director of Research, also a CFP. Hey, Matt.
Hey, Danny.
Okay, here we go. I have retirement accounts in 3 different places, 2 IRAs, 1 401k, 1 brokerage account total. What are the upsides/downsides to consolidating them? Where do we start, up or down?
Let's start with the good news. There are a lot of pros to consolidation. The way that I think about it is all of your investments need to be working together. Although they may be in different names as far as the types of accounts, they may have different tax rules and things along those lines. All of them combine to focus on one solid plan. And when you think about consolidating those, one of the biggest pieces is simplified management, right? It's going to be easier to track performance. Different companies, different types of investments, depending on the company, they may report performance differently. So it's good to get an apples to apples comparison. You also are going to be able to monitor your asset allocation better. So you could have, let's say you got a lot of a certain stock within a mutual fund at one company. You could also have that same stock at another company. It's very difficult to track those if you don't have those at one company and they're all talking to each other. And then also tax efficiency. Again, when things are consolidated, you're able to more efficiently track what are cap gains, what does your ordinary income look like, where do you need to withdraw from, all those types of things. Also, you want to look at better investment oversight. So again, well-diversified portfolio, no redundancy. And then last but not least, savings. All investments have costs, whether that's maintenance fees, whether that's trading costs. Also, typically when you have lower balances, you pay a little bit higher of cost. So when you consolidate those, a lot of times you may be able to negotiate a lower fee or things along those lines. When it comes to cons, tax consequences can be a con, especially for those brokerage accounts. Some firms, if you consolidate into that firm, they'll force you to sell your investment positions, which could trigger unnecessary capital gains. At Annex, we evaluate what your current gains are before we just go and sell it. And then you also may have some limited investment choices. Certain firms, they have only certain investment choices. Say they have 5 different portfolios, and you could be forced into one of those portfolios.
Next question on Ask Annex. Does it make sense to choose a target date fund if I'm only 5 years from retirement?
I would say if you got 5 years to retirement, 5 years is still 5 years. It's still really important. So whatever investment decision you make, I wouldn't minimize anything based off the time frame. When you think about target date funds, really what you're looking for is a simple, automated way to invest that you can be hands off on and let somebody else kind of take the wheel for you. And so from an efficiency standpoint, for 5 years, if that's what you're looking for, that's a great way to do it. As you get closer and closer within that 5 years, it's going to start to become more conservative. It's going to change that allocation mix and get you into a spot that's ready for retirement. Now, a potential con with that is that it's assuming that everybody who's retiring in 5 years from now has the exact same risk tolerance, and that might not be correct for you. So you might not necessarily want to pick the target date fund that's 5 years out. If you're more aggressive, you might want to pick something that's 10 years out. Even though it doesn't match up for your retirement, it might match up for your risk better. The other thing I would think about too is if you're a client of Annex, we review 401k options for clients all the time and can create something for you and help provide suggestions for you to invest that's really specific to who you are, what your risk tolerance is, what your needs are out of that account, and help complement the things that we're doing here. So if you're a client of Annex, that's a great way for us to help you out on there as well too.
Fred, target date funds are pretty good for somebody that's just starting out, right? Somebody that got out of college and they've got a 401k and they don't want to think too much about it, right? It's not a bad place to land.
Potentially, it really depends on if you have help or not. Like Matt said, if you work with Annex, we're going to look at all the investment choices that you have within the 401k, and we're going to pick the best ones. But for someone that doesn't have an advisor and just wants to kind of, set it and forget it, then that's when target date funds could be a good option.
Fred Coleman is Branch Director, CFP, also a Wealth Manager. Thank you.
Thanks, Danny.
Matt Morzy, Director of Research, also CFP, and part of the investment team at Annex Wealth Management. Appreciate it.
Thank you.